Welcome back to the Did You Know channel. If you're new here, here's a tip. You don't have to watch the screen. Just play this video in the background while you're washing dishes, working out, or just relaxing. Simply listen, and you'll get all the essential information. Today, we're going to look at 5 undervalued stocks that could be great investment opportunities right now. The markets have been quite unstable in recent months. As Warren Buffett famously said, "Be greedy when others are fearful." And right now, fear is dominating the markets. Stock markets have experienced a decline since the beginning of the year. The S&P 500 is down about 3.72% as of March 20th, 2025. The Fear and Greed Index, which measures investor sentiment, is currently at 23, indicating extreme fear in the market. This fear is causing many investors to sell off their positions. But for long-term investors, this could be a signal to start buying high-quality stocks at discounted prices. Markets always move in cycles. When investors panic and sell, experienced investors see an opportunity to buy. Many strong companies that were expensive just a while ago are now trading at attractive valuations. Today, we'll break down 5 specific stocks that, based on my analysis, are among the best undervalued companies in the market. We'll look at their performance, valuation, and whether now is the right time to buy. So, if you want to find out where the real investment opportunities are, keep listening. When people hear Google, most of them just think of a search engine, but Alphabet is much more than that. It owns YouTube, Android, Google Cloud, and, of course, a massive advertising business that generates billions of dollars in revenue every year. Despite being one of the strongest tech companies in the world, its stock has dropped by around 14% in recent months and is now trading at $162.80 per share. Why? What's causing the drop? Concerns about slowing ad revenue. Google Ads is still Alphabet's biggest revenue source, and when digital ad growth slows down, investors start to worry. Competition in AI, Microsoft's Bing AI and OpenAI's ChatGPT have introduced serious competition for Alphabet. Massive investments in AI and cloud computing. Alphabet is pouring billions into artificial intelligence and cloud services, which is temporarily affecting profits. But now, let's look at the other side of the coin. Why could Alphabet be a great investment? Alphabet is still an advertising giant. Even with the slowdown in ad revenue, YouTube and Google Ads continue to bring in huge profits. Google Cloud is growing fast. This division's revenue has been increasing at 19% annually, proving that Alphabet is building a strong position beyond advertising. AI will be crucial. While Alphabet is facing strong competition in AI, its own developments, like Bard and Gemini, are shaping up to be a major part of its future. My strategy? Right now, Alphabet stock is trading around $162.80, which I see as a good entry point. If it drops below $150, it would be an even better long-term buying opportunity. Alphabet still has a strong financial position, massive resources for innovation, and a stable business model. So, we've talked about Alphabet and how it might be a great long-term investment despite its recent stock decline. Now, let's move on to another tech giant that's facing similar challenges. Amazon. This is a company that has completely transformed e-commerce, cloud computing, and AI. Yet despite its dominance, its stock has also taken a hit recently. Amazon stock has dropped by around 10% this year, now trading at $194.95 per share. Just a few months ago, it was sitting at over $240 per share, meaning it's fallen more than 20% from its recent highs. For a company as strong as Amazon, this kind of drop raises an important question. Is this just temporary? Or is there a bigger problem? What's behind the decline? One of the biggest concerns for investors is the state of the global economy. When consumer spending slows down, it directly impacts Amazon's e-commerce business. There's also growing regulatory pressure, with governments around the world scrutinizing Amazon's market dominance. And then there's the cloud computing slowdown. Amazon Web Services, AWS, has been the company's most profitable division. But some investors fear that growth in cloud services won't be as explosive as before. But here's the thing. Amazon is much more than just an online store, and its business is built for long-term dominance. Why Amazon could be a strong buy right now. AWS is still the market leader. While some fear slower cloud growth, AWS is still growing at over 19% per year, making it the largest cloud provider in the world. E-commerce remains strong. Even with increasing competition, Amazon holds a massive share of global online retail, and its Prime subscription model keeps customer loyalty high. AI and automation investments. Amazon is heavily investing in AI-driven logistics, smart warehouses, and automation, which could boost efficiency and profitability in the long run. My strategy? At its current price of $194.95, Amazon looks fairly valued based on its growth potential. If the stock dips below $180, I see it as an excellent opportunity for long-term investors. Given Amazon's dominance in cloud computing, its expanding AI strategy, and its leadership in e-commerce, this company remains one of the best stocks to hold for the next decade. So far, we've talked about companies like Alphabet and Amazon, which are household names. Now, let's shift our focus to a company that isn't as well known among casual investors, but plays a critical role in the tech world. I'm talking about ASML, a company without which modern chips simply wouldn't exist. ASML is a Dutch company that manufactures lithography machines essential for producing the most advanced semiconductors. In other words, if you want to manufacture high-performance processors for smartphones, computers, or even cars, you need ASML's technology. Without their machines, companies like Intel, NVIDIA, and TSMC wouldn't be able to produce the chips that power today's world. Even though ASML is an irreplaceable player in the semiconductor industry, its stock has dropped by around 10% in recent months and is currently trading at $683 per share. Why? The main reason is the temporary slowdown in chip demand. Chip manufacturers are worried about lower sales and are reducing orders for new production equipment. But keep in mind, this is a short-term fluctuation, not a long-term trend. Let's look at the numbers. In Q4 2024, ASML reported revenue of 9.3 billion euros, exceeding expectations. And even though chip demand has slowed slightly, ASML forecasts 2025 revenue between 30 billion euros and 35 billion euros, with a gross margin of 51% to 53%. This means the company is still generating huge profits on every machine sold. To sum it up, ASML has a monopoly on lithography equipment. Its technology is crucial for the entire semiconductor industry, and its long-term outlook remains very strong. That's why I believe ASML stock is a solid long-term investment at its current price. Now, let's move into a completely different sector, digital payments. The next company on our list is PayPal, and it could be another great investment opportunity. So far, we've talked about tech giants like Alphabet, Amazon, and ASML, companies that dominate their industries and still have strong long-term potential. But now, let's shift gears and talk about a company that's been hit even harder than the others. I'm talking about PayPal, a pioneer in digital payments that has seen its stock price crash by more than 20% this year. Just a few years ago, PayPal was viewed as one of the strongest fintech companies in the world. But lately, it's been struggling. Investors have lost confidence, and its stock has been in a steady decline. So, what's going on, and is this a chance to buy PayPal at a discount? What's driving the decline? There are several reasons why investors have turned against PayPal. First, competition has intensified. Apple Pay, Google Pay, and even emerging fintech startups are stealing market share. Second, growth has slowed down. While PayPal is still a profitable company, its revenue growth has dropped below expectations. And finally, there's been a change in leadership. A new CEO, Alex Chris, has stepped in, And while he has big plans for the company, the market remains skeptical. But does this mean PayPal is doomed? Not necessarily. Why PayPal might actually be a great buy right now? Valuation is at an all-time low. PayPal stock is currently trading at a PE ratio far below its historical average, making it one of the cheapest fintech stocks on the market. The company is still a major player in digital payments. With over 400 million active users, PayPal remains one of the largest online payment platforms in the world. New management is focused on efficiency. The company is cutting costs and focusing on profitability, which could boost earnings in the long run. My strategy? Right now, PayPal stock is trading at levels we haven't seen in years, and for long-term investors, this could be a rare buying opportunity. If the company executes on its turnaround strategy and reclaims its leadership in digital payments, there's significant upside potential. So far, we've gone through major tech giants like Alphabet and Amazon, discussed a crucial semiconductor company in ASML, and looked at how PayPal has struggled in the digital payment space. Now, let's focus on a company that has been at the center of the semiconductor industry and has seen some of the biggest price swings in recent years, AMD. If you've been following AMD for a while, you know that this company has had a wild ride. It went from being an underdog struggling against Intel to becoming one of the top players in the CPU and GPU markets. But despite its massive progress, AMD's stock has dropped by 17% this year and is now sitting at around $98 per share. Compared to its all-time highs, we're looking at a nearly 50% decline. What's causing the decline? There are a few key reasons why AMD has struggled recently. First, the semiconductor market is cyclical, and after years of rapid growth, demand for chips has slowed down. Second, competition in AI is fierce. NVIDIA dominates the AI chip market, and investors are worried about AMD's ability to catch up. And third, the broader tech market is in a correction phase, meaning even strong companies like AMD are seeing their stock prices decline. But here's why AMD could be a great opportunity right now. The AI revolution is just getting started. While NVIDIA is leading in AI chips today, AMD is aggressively investing in AI hardware and could become a major competitor in the coming years. The company is fundamentally strong. AMD has significantly improved its financials with rising revenue and profit margins over the past few years. The market is overreacting. A 50% drop in stock price doesn't match AMD's long-term growth potential, which means this could be a great time to buy. My strategy: at around $98 per share, AMD is trading at a price that seems disconnected from its long-term potential. If it drops further, I see it as an even better buying opportunity. The company has positioned itself as a key player in high-performance computing, gaming, and AI, which makes it one of the most exciting semiconductor stocks to watch. So, we've gone through 5 major companies: Alphabet, Amazon, ASML, PayPal, and AMD, each of them facing challenges, yet each presenting a potential opportunity for long-term investors. But identifying undervalued stocks is just one part of the equation. The bigger question is, how do you actually invest in times like these? Right now, the market is in a volatile phase. Stock prices are swinging, fear is high, and many investors are selling out of panic. But if history has taught us anything, it's that markets move in cycles. Every downturn is eventually followed by recovery. So, how do you position yourself to take advantage of these cycles instead of falling victim to them? Diversification is key. One of the most important principles of investing is not putting all your eggs in one basket. Even if you believe in one stock, putting everything into it is too risky. The best approach is to build a balanced portfolio that includes different sectors: tech, finance, consumer goods, healthcare, and even commodities. This way, if one sector takes a hit, the others can help stabilize your overall returns. Think long-term, not short-term. If you're investing in stocks, you shouldn't be worried about what will happen next week or next month. Instead, focus on where these companies will be in 5 or 10 years. Look at how businesses are growing, how they're expanding into new markets, and whether their long-term vision makes sense. Short-term dips don't matter if you're holding high-quality stocks for the long run. Valuation matters, don't overpay. Even great companies can be bad investments if you buy them at the wrong price. That's why looking at metrics like price to earnings, PE ratio, revenue growth, and cash flow is important. The key is to buy when stocks are undervalued, like some of the ones we just talked about. Cash is also a position. Sometimes the best move is not to invest at all. If the market feels too uncertain or you don't see any clear opportunities, it's okay to hold some cash on the side. This gives you flexibility to buy when a great opportunity comes, instead of being fully invested and having no cash left when stocks hit rock bottom. Learn to control emotions. The biggest mistake investors make isn't choosing the wrong stock. It's letting emotions take over. When markets crash, fear makes people sell at the worst possible time. And when stocks soar, greed makes them buy at inflated prices. The best investors stay rational, patient, and disciplined, no matter what's happening in the market. So, what does all this mean? It means that right now, we're in a market where fear is dominating, but history tells us that these are the times when smart investors make the most money. The stocks we've discussed today might not all go up tomorrow or next week, but over the next few years, they have serious potential. We've talked about 5 undervalued stocks and how to invest during uncertain times. The most important thing to remember: fear creates opportunity. Long-term investors don't panic, and they take advantage of the market when prices are low. Right now, some of the strongest companies in tech, semiconductors, and digital payments are trading at a discount. No one can predict exactly when the market will turn around, but history shows that buying solid companies during downturns pays off in the long run. So, what do you think? Are any of these stocks worth buying, or do you have your eyes on something else? Let me know in the comments. If you found this video useful, hit like, subscribe, and turn on notifications so you don't miss the next one. Thanks for listening, and I'll see you soon.